You can't pick up a newspaper at the moment without reading about the doom and gloom of the UK housing market. And virtually every day in the Moneywise office, we receive a new report or press release warning of crashing house prices throughout the UK. Now, whether this will happen is anyone's guess, but house prices are certainly set to slow in 2008 as the rampant inflation we've seen for so many years comes to an end. Of course, for first-time buyers, this is good news. But it's not so good for last year's first-time buyers who stretched themselves to the limit to get onto the property ladder. And for those who've taken out mortgages of 100% loan to value, as they could find themselves owing their mortgage lenders more than their home is worth. And so, the return of an unwelcome phrase we haven't heard for more than 15 years, negative equity. Yet for many people, like 25-year-old Lucy Bicknell and her boyfriend Dan Jones, who is 26, it is the only option. They bought their one-bedroom flat in Hemel Hempstead in Hertfordshire in September last year.
We had a mortgage broker and he advised us to take out 100% mortgage just because we didn't have a substantial amount of deposit to put down for the house. The other options, they wanted 10% of the home value to put down as a deposit and we just couldn't afford it. All the money we had saved up for the deposit had to go on legal fees and solicitors and stamp duty, and after we've paid that off, we didn't have any money left over.
Lucy and Dan also opted for an interest-only mortgage to keep their monthly repayments down. They plan to switch to repayment in the future, but the £890 they pay each month is neither repaying the capital they have borrowed nor building up any equity in their home.
Obviously, we have heard all these stories that the housing market is going to drop within the next year or so, and we do think what's going to happen to us. We've put all our money into this place, we can't afford a bigger place, and we've got to stay here for a good few years until we've actually saved up some money to pay off for the equity of the house. It is quite worrying. We don't really know what to do. There's nothing we can do. We've just got to try and stick it out.
Lucy and Dan are well aware of the burden they've taken on and the potential risk. But are mortgage lenders irresponsible for offering such large loans in the first place? I went to ask Chris Tapp, Director of Debt Charity Credit Action, to find out.
I do think that what we've seen has sort of bordered on the irresponsible because of the way that even when it was clear that the housing market was going to slow significantly, even as late as this summer, sort of August, September of this year, mortgage lenders have still been pushing these very large mortgages. And knowing that the housing market was likely to struggle, I think that it's certainly not unfair to term that irresponsible behaviour.
Of course, the risk of negative equity not only depends on what happens in the housing market, but also on individual homeowners. If you plan to sell up quickly, then yes, it could well be a problem and you may have to stay put in the short term. But if, like Lucy and Dan, you plan to stay in your new home for a good few years, then it shouldn't be a problem as house prices pick up in the future. As this graph of UK average house prices shows, following the last period of negative equity when house prices took a dip during the late 80s and early 90s, the market did recover. If we're set for a similar period, homeowners with 100% mortgages or more will simply need to sit tight for the same to happen again. This is Hannah Ricci for Moneywise TV.